Let's understand what a balance sheet is. Let's take the word sheet. Sheet just means it's a statement. It's a report. Report of what? A report of certain items which balance each other in a certain way. Now let's see what those items are which are reported by a balance sheet and how they balance each other. Before that, let's just understand that this report called balance sheet is nothing but a quick snapshot or still picture of the company's financial position. Snapshot meaning just imagine the business as a movie. The movie begins with someone putting money into the company, buying machinery and kick-starting the business, bearing the expenses and finally making some sales, paying off taxes, interest on loans and hopefully making some profits. This cycle repeats itself. At any particular point in time, you take a screenshot of this movie and take a quick summary of what has happened so far. The screenshot tells you, for example, that you put in 100,000 rupees of money as investment, brought a loan of 100,000 rupees. The total investment in the business is 200,000 rupees, of which you owe 100,000 rupees towards loans, but you also made some profits of 50,000 rupees. Net, your business is giving you back 150,000 rupees because the loan amount of 100,000 rupees needs to be paid back. But your business is giving you 150,000 rupees, which is great because the business made up something for you. This something you may want to reinvest a portion back into your business by buying some machinery and distribute some amount as dividends to your shareholders. Depends on your strategy. Let's not think about dividends now for the sake of this example. This something that the business is giving you back is nothing but equity. Imagine equity as something like what will be returned to you and other shareholders of the company. You know who shareholders are, right? All the people who invested money in the company. So imagine equity as what will be returned to the shareholders if at this moment we were to sell the company. When the company is sold, everything that the company owns is sold. Every penny that the company borrowed needs to be paid off, and whatever the company is left with is distributed to the people who invested in the company. So that amount which is returned to the company's shareholders in a hypothetical situation like selling the company or just what belongs to the shareholders is nothing but the equity. Equity is basically your right to the business. Sounds good? Going ahead, let's just think. Why are we preparing a balance sheet? To whom should we show it? Well, the answer is the investors, the lenders, the financial analysts, and all the people or organizations who are interested in knowing the financial health of the company. Now, coming back to the point, we just said that the shareholders put in some money for starting the business. But that money doesn't remain as cash. Why would it? We started a business with that money. Well, that's the whole point of the money. So what did we do? We got machinery, equipment, building, some raw materials and other component parts called inventory. We paid for some patent or copyrights. We made some sales for which the other party didn't pay us yet. We also have some cash. So anything that our business proudly owns and offers us some economic benefit now or in future is nothing but an asset. Well, we purchased so much stuff with the money we invested. But wait, we purchased all these not just with the money we invested, but we also took a loan. We need to repay them. We have some obligations. These obligations are nothing but liabilities. Whatever the business owes to others, be it a bank loan or you just purchase some supplies for your business, but you didn't pay your suppliers yet. They are also your liabilities because you owe them money. So, using the money you and the other shareholders invested and also the loan amount, you developed some assets for your company. Now, if at all we imagine a situation that we are going to sell the company, what are you left with? You sell your assets, pay off your liabilities, and whatever you are left with, you distribute the amount to all the shareholders. That's just the take home or the equity. As we said, the balance sheet balances out certain things. Let's see what it balances out. 200,000 rupees worth of assets like machinery, inventory, etc. and a profit of 50,000 rupees, let's say. The profit is also in cash. Cash is also an asset, right? Totally 250,000 rupees is what the business proudly owns. But the business owes somebody something. 100,000 rupees to the bank for the loan amount. Let's say we also paid 20,000 rupees as interest. So totally the liability meaning the obligation is 120,000 rupees. If I were to sell this business right at this moment, what am I left with? After paying the loans, 130,000 rupees, right? Wow, this is my take home. My take home meaning not just mine, but all the shareholders, because they also put some money. They deserve a part of this take home. So what are we all as shareholders taking home? Totally 130,000. That's what the business gave us. That's the equity. Do you see the balance here? We are balancing the assets of the business with the sum of its liabilities and equity. So, our balance sheet is ready. Well, this is a crude example. Now let's dig a bit further and this time let's introduce few more terms. Are you ready? So, what are the three main sections of a balance sheet that we are trying to balance? Assets, liabilities, and equity. Let's consider the section assets. Let's write all the assets our business owns, but let's write them in the order of the most liquid assets to the least liquid assets. Liquid means it is easily convertible to cash. The most liquid form of an asset is, of course, the cash. Why do we maintain cash as an asset? Cash is the lifeblood of a business. You need cash to pay for the expenses and other bills. Cash gives you the flexibility for your regular transactions. Let's say we have 40,000 rupees as cash. What's the next most liquid asset? Cash equivalents, meaning those items which can easily be converted into cash. Say for example, you made some short-term investments which mature within 3 months. Let's say we have some short-term investments worth 30,000 rupees. Accounts receivables, meaning you sold your goods to someone but are yet to receive the payment. Let's say we are to receive 70,000 rupees. What comes next? Inventory. Inventory definitely has some economic value and supports your business. Say for example, the raw materials which are halfway through the process of manufacturing, finished goods yet to be sold, or if you are in a retail business, the merchandise. Let's say we have inventory worth 20,000 rupees. Next comes any insurance that you have paid already, prepaid insurance, or any prepaid expense like rent for the building which we have paid in advance. Next comes certain fixed assets like property, that is land and building. Then we have plant, meaning factories, other equipment like the machinery, total worth 80,000 rupees. But wait, the land, buildings and machinery were purchased say 5 years ago. there is some wear and tear associated with these items. Their value decreases as days pass, right? So let's give some number to this wear and tear and call it depreciation. There is some depreciation accumulated over the years for these machinery, say 10,000 rupees. Now let's take a close look at all the assets we have listed. As I said earlier, we list the assets from the most liquid form to the least liquid form. See, cash is the most liquid asset in the top position. Machinery is the least liquid. Obviously, you can't convert it into cash sooner. Well, it's required for your business. The assets can be divided into two categories. The assets which can conveniently be sold or used up by business very soon, within 1 year. These kind of assets are used up as part of your standard day-to-day business operations. Hence, these assets which have the feasibility of being sold and converted to cash are just eaten up by your business within 1 year for its operations. Let's name these kind of short-term assets current assets. If you look at the remaining assets we have listed, they are all long-term, meaning we will maintain them for many more years to come. So you don't sell your building or machinery often and make cash out of it, right? So let's call these assets long-term assets. There can also be some long-term assets like patents and trademarks. So essentially, we finished one section of our balance sheet called the assets, where we listed the short-term assets called current assets and long-term assets. Sounds good so far. Liabilities are what the business owes to others. Like we discussed here also, just like in the case of assets, we have current assets and long-term assets. We have current liabilities like accounts payable. That is, you purchased some inventory from your suppliers, you need to pay them in few months. Salaries, rent, short-term debts. Short-term debts could be some borrowings to be repaid within 1 year or just a portion of the long-term debt which is repaid now within short term. And long-term liabilities include those financial obligations which are due more than 1 year. For example, maybe you invested or issued some bonds, mortgage, capital leases. There may also be some contingent liabilities which may or may not occur. For example, someone has filed a lawsuit of 40,000 rupees. The company will have to pay this amount if the other party wins the case, right? For the sake of simplicity, I am not including contingent liabilities here. The total liabilities come to 110,000. Let's come to the equity section. We essentially have two main heads in the equity section. One is the share capital and the second one is other equity. There could be many ways of presenting the equity information, but these are the most common terms. Share capital is simply the total money raised by the company. Suppose the company has issued 40,000 shares to public at 1 rupee face value. 40,000 rupees is what we call common stock. That's just the public's money. That's just the common stock. Another way for the company to raise money is through preferred stock. Let's not discuss too much about preferred stock. For now, just assume that preferred stock represents the shares issued with some special privileges to some important persons. Let's say the company issued preferred stock worth 20,000 rupees. In essence, the total capital raised, that is the total money gathered by the company for investment into its business, is 60,000 rupees. Other equity comprises a whole lot. Let's just discuss few simple and important components of other equity. Reserves could be some money set aside for major investment projects or other important future expenses. Let's say we saved a reserve of 40,000 rupees. Retained earnings means the earnings of the company minus any dividends paid to the shareholders. Imagine we didn't pay any dividends, we are retaining or saving some portion of the earnings for the purpose of investing back into the company. Maybe we want to build a new factory to expand our business. The retained earnings are 40,000 rupees. You must have observed something. The assets of the company equal the sum of liabilities and equity, meaning whatever the business owns is a sum of what it owes to others and what is left over to be distributed to the shareholders. This is how roughly a balance sheet is written. Don't miss our next video where we are going to discuss some practical examples of important things to look for in a company's balance sheet.